Welcome to the Value Vault, separating headlines from high stakes.
And welcome to this deep dive.
Today, we're really opening up quite a fascinating stack of source material. It really cuts across the biggest shifts happening, right now.
Yeah, everything from global macro and market mechanics to, well, Bitcoin, AI.
And how governments are starting to grapple with all this new tech. It's a lot.
It is. And our mission for you today is really to act as your guides through this, well, pre-complex information environment.
Exactly. We've pulled insights from Anthony Pompliano, Raoul Pal's Real Vision and the Journeyman series.
Yep, great stuff there.
And Mark Meldrum's latest Q&A. So a diverse set of sources.
Definitely. But they offer these, crucial nuggets of knowledge, some surprising facts, perspectives that can genuinely help you navigate what's happening.
And maybe more importantly, why it matters.
Exactly. Think of this as, a shortcut. Getting you well-informed, bypassing the noise, getting straight to the most valuable insights.
We're aiming to unpack what's most important for your understanding and maybe even potentially for your decisions down the line.
Okay, let's get into it.
Right, let's unpack this. We're kicking things off today by diving into some of the sharp insights coming from the internet's favorite Italian in fintech, Anthony Pompliano.
Pomp. Yeah, he covers a lot of ground.
He really does. Everything from these big generational economic shifts, the frankly surprising strength in the stock market, to how traditional finance and, even governments are exploring new ways to interact with Bitcoin.
Right, and that first point, the generational shift, it's kind of foundational, isn't it? It sets the context for a lot of the other things he talks about.
Explain that a bit more. What's the core of that shift he sees?
Well, it's this move away from what was, for centuries really, a physical, industrial, manufacturing-based economy.
Right, how we built wealth,
Yeah.
how progress happened, factories, railroads, tangible stuff.
Exactly, towards something fundamentally different, much more centered on electrical power, robotics, computation. It's this digital, automated, electrified future that's really taking shape.
And his point is, if we're really living through that kind of massive structural shift, it's not just a minor adjustment.
No, it's huge.
Then it just naturally follows that we're going to see this just massive increase in computing power coming online.
Consuming more energy, being applied everywhere.
Across every sector for all sorts of different things.
Right. And within that context where computation and energy are becoming so central to economic activity, well, Bitcoin is kind of inherently positioned as a big winner.
How so?
Because it's very security, its operation, it's fundamentally built on computation and energy consumption.
It's a proof of work.
Right. It aligns perfectly with this emerging economic structure that's all about computation and energy.
Okay, that makes sense. And that ties directly into something else he flagged recently.
Yeah.
This intriguing stance from J.D. Vance, the U.S. Senator.
Yeah, that was interesting. Vance seemed quite, bullish on Bitcoin in an interview, Pomp noted.
It immediately raises that question, doesn't it? For anyone trying to figure out the political and regulatory side of things.
How much is just talk?
Exactly. How much is sentiment, maybe political posturing for a certain base, versus actual concrete action?
Are we just watching policymakers learn about this stuff, get comfortable, and then, bam, suddenly an announcement? Or actual government buying?
It's that classic talk versus action debate. But the way Pomp framed it is fascinating. You don't want to be short the U.S. government on this.
That sounds, a bit counterintuitive at first glance, maybe. Shorting the government on anything usually seems like a bad idea.
Right. But his argument isn't about betting against, the stability of the government itself.
No, it's about betting against their potential positive impact on Bitcoin specifically.
Okay. So if they do get involved, buying, holding favorable policy.
There's this huge asymmetric information aspect, right? They know things we don't, and they can act whenever they want.
And any action they take, especially buying or a positive policy announcement, would almost certainly have a, profoundly positive impact on the Bitcoin price.
Totally. So if influential people are starting to talk bullishly, you don't want to be caught holding a bearish position if they suddenly decide to act. It's a major risk asymmetry.
Yeah, you could get run over.
For sure.
And that leads right back to his broader take on Bitcoin, which I find really compelling. He frames it as having become effectively the hurdle rate for a new generation of investors.
The hurdle rate. Okay, break that down for listeners maybe more used to traditional finance terms.
Sure. So in finance, a hurdle rate is just the minimum acceptable return you need on an investment.
Right.
If a project or investment can't potentially clear that hurdle, you pass on it.
Right.
Pomp's point is that for a growing number of investors, especially maybe younger ones, Bitcoin's historical performance, combined with its potential in this new computational economy. It sets a new benchmark.
So if you look around and can't find anything else you think can reasonably outperform Bitcoin over the long haul,
You just buy Bitcoin. As he put it, if you can't beat it, you got to buy it.
that's a really powerful way to think about it. And within that frame, the best strategy, looking back over the last 15 years, it hasn't been super complicated market timing or reacting to every news headline.
No, not at all.
What's consistently cleared that hurdle rate and done incredibly well long term, just simple dollar cost averaging DCA into Bitcoin.
Right. DCA, just investing a fixed amount regularly no matter the price, smooths out your entry over time.
It's exactly like the traditional advice for investing in, say, the S&P 500 index, isn't it?
Totally. You don't know where the S&P is going next week, but historically, driven by growth and monetary policy, it goes up and to the right over decades. So the advice is just DCA and hold.
And Pomp's arguing Bitcoin is becoming that kind of fundamental long-term store of value and growth asset for this new era.
So while analyzing all the details, debating macro, trying to predict the daily moves, that's intellectually stimulating, sure.
Yeah, it's interesting.
But the practical reality, the thing that actually matters most for the price long term, is maybe simpler. Capital is just flowing into the Bitcoin network.
And that flow creates its own momentum, right? A kind of virtuous cycle.
Explain that.
Well, people put capital in, maybe institutions now through the ETFs, they see attractive returns over time. That encourages more capital to come in, which pushes the price higher.
Rinse and repeat.
Exactly. The core action driving the price isn't just moment-to-moment speculation. It's this fundamental flow of capital seeking the highest potential return against that Bitcoin hurdle rate. It's a shift in how investors benchmark opportunities.
Okay, speaking of asset prices and capital flow, let's shift slightly to the stock market. Pomp touched on this too with that great quote.
Yeah. Doomers make headlines, optimists make money.
And May was just a perfect example of that, wasn't it? Despite all the persistent bearishness out there.
We saw what he called the best May for stocks in 35 years.
35 years. That's a long time. And it definitely felt like a surprise to a lot of people in the market.
He described it as a classic case of everyone being caught off sides, positioned the wrong way for the move that actually happened.
Right. People were surprised when the latest tariffs actually went through. They thought it was just posturing.
And then they were doubly surprised by the strong market rally after that.
Yeah, exactly. And to back this up, he brought in Ryan Dietrich. He's the chief market strategist at Carson Group.
Right. A big RIA manages something like $40 billion.
Yeah, substantial. And in their chat, Dietrich shared this really compelling, specific statistic about May's performance.
Oh, yeah. The S&P 500 returning 6% in May. Dietrich pointed out this has only happened 6 times before in history.
Only 6 times. And the follow-through, according to Dietrich's research, is just remarkable.
What was it? In all 6 previous times, the S&P gained 6% or more in May. 100% of the time.
Mm-hmm.
The market was higher 12 months later. Every single time.
Every single time. And not just like fractionally higher.
No. The average return in the 12 months after a 6% May gain was a hefty 20%.
Wow. Okay, so Dietrich basically emphasized that based on this historical data, May is statistically the single best predictor of performance for the next year.
Yeah, a gain over 5% in May, he said, had an 84% probability of strong short-term performance.
And as you just said, 100% historical probability of being higher within 12 months.
So if history is any guide at all, we should be expecting good things for stocks over the next year, based purely on that May stat.
And yet, despite that powerful data, it feels like, as Pomp put it, this is the most hated rally of all time.
Totally. So many people seem to be fighting it, convinced it shouldn't be going up because of their bearish macro views.
It's that clash of perspectives, isn't it? You can stand there and fight the tape, argue the market's wrong, irrational.
Or you can acknowledge, like Pomp suggests, that the market's the referee. Meaning the market is aggregating all the information, all the opinions out there. If the market is telling you something different than your personal framework, well, maybe you missed something. Maybe your model's incomplete.
Interesting point. And why were so many bears wrong, according to this view? They kept calling for crashes.
Yeah, doom and gloom constantly. But they seem to ignore or downplay things like, record corporate earnings in many sectors.
Right. Companies were making money.
And corporate credit spreads were really healthy, meaning companies weren't stressed about borrowing. Plus, the basic fact that fiduciaries managing huge pools of money pensions, endowments, RIAs like Carson Group,
They have a duty to invest for potential gains, right?
Yeah,
Not just hide in cash because of fear.
exactly. They have to position for upside, regardless of the political noise or media narratives.
And there's undeniably a lot of politics driving fear-mongering, especially election year stuff.
Oh, yeah. And bearish takes get amplified so easily on social media, creates these echo chambers.
And weirdly, consumer confidence surveys, like the Michigan one, have stayed really low. It seems totally disconnected from positive market data and low unemployment.
It's a very strange divergence, that sentiment versus actual market performance.
Definitely. Hey, if you're finding value in this deep dive, maybe drop a like and share if you find this valuable.
Good idea. Okay, let's circle back to Bitcoin for a sec, because traditional finance and governments, they're not just watching anymore, are they?
No. There's this palpable desire to get access, and these new kind of fascinating structures are emerging. Pomp, drawing on research, highlighted this concept of bit bonds.
Yeah, this idea has been explored by people like Sam Lyman at Forbes, the Bitcoin Policy Institute. It's a really creative way to bridge the massive traditional bond market with Bitcoin.
Walk us through it. How would these bit bonds actually work?
Okay, so the proposed structure is pretty neat, designed to appeal to both governments needing funds and investors wanting Bitcoin exposure with some safety.
Uh-huh.
When these bonds are issued, most of the money raised, let's say 90%, goes straight to the government issuer. Just like a regular treasury or a municipal bond, they use it for whatever they need.
Standard bond stuff so far. What's the twist?
The twist is the other 10%.
Yeah.
That portion of the funds raised is used by the issuer to immediately buy Bitcoin.
Okay. And how does the investor benefit from that Bitcoin?
The upside for the investor is structured. They'd get 100% of the gains from that 10% Bitcoin allocation, but only up to a certain threshold, maybe like a 4.5% compounded annual return.
And above that?
Above that, there's a split. Say the investor gets 50% of any additional Bitcoin upside, and the government keeps the other 50%.
Ah, so the government isn't just raising funds, maybe at a lower interest rate because of the Bitcoin kicker.
Right, lower coupon, potentially.
But they're also using it to build a strategic Bitcoin reserve for themselves with that retained 50% of the extra upside.
Exactly. It's potentially a win-win for the government, lower borrowing cost, and they accumulate a Bitcoin reserve over time.
Jordi Vistar, guy with 30 years on Wall Street, apparently called this a key example of the old fiat industrial economy really merging with the new digital one, creating a new capital structure.
Yeah, and from a capital markets view, you can see why institutions and governments are looking at this. Capital flows where the demand and opportunity are, right?
Makes sense.
Crypto fundraising often gets oversubscribed, massive demand. Meanwhile, traditional areas like PE, IPOs, M&A have been slower lately.
So the huge traditional bond market is basically finding ways to tap into that Bitcoin demand.
Precisely. And for governments, it's super attractive. Fund debt potentially cheaper by offering Bitcoin upside instead of just a higher interest rate.
And for investors, institutions, or even retail through funds, it's principal protection, get your money back, barring default, plus that potential Bitcoin return. Fits that hurdle rate idea again, but in a traditional structure.
Exactly. Incorporating Bitcoin's potential into a structure that fits existing regulatory boxes.
And it's not just theory, right? There were rumors about the U.S. government itself considering this.
Yeah, potentially for the national debt. And NYC Mayor Eric Adams apparently committed to issuing the first city-level bit bond.
And it's global, too. Russia's Spur Bank, their biggest bank, reportedly launched a structured bond tracking Bitcoin and the USD/RUB exchange rate.
Right, initially for qualified investors. Shows the concept is spreading.
So, pulling it all together from Pont's perspective here, Bitcoin's a magnet for capital. The massive bond market wants in. And we're likely going to see a plethora, as he said, a whole bunch of these new Bitcoin-related bond structures coming.
Yeah, the bond market isn't just watching from the sidelines anymore. It's definitely knocking on Bitcoin's door.
And bringing it back to that traditional finance view, Ryan Dietrich from Carson Group also talked about their general market positioning and specifically how they handle Bitcoin access for their clients.
Right. So generally, they're positioned, as he described it, overweight equities, still bullish on stocks overall.
Overweight meaning holding more stocks than a typical benchmark allocation.
Correct. They've also added some exposure to developed international markets, specifically mentioned Europe and Germany, seeing positive fiscal signs there.
Okay. And within the U.S.?
Still, like U.S. large caps, big companies, specifically mentioned cyclicals, banks, financials, some tech, basically sectors that do well if the economy avoids recession, which is their base case.
What about bonds?
Underweight fixed income currently. They are holding some gold, have been since April 2023 as a hedge. And they use managed future strategies, too, for diversification.
And their overall philosophy for clients navigating volatility.
Simple but powerful. When in doubt, diversify it out. Helps people sleep at night.
Crucially, though, on Bitcoin, Carson Group was one of the very first large RIAs to actively provide access to the spot Bitcoin ETFs for their clients and advisors.
That action, providing access from a big, regulated fiduciary firm like that, it really speaks volumes, doesn't it?
Absolutely. They can't give specific opinions on Bitcoin due to rules, but enabling access implies they see it as a legitimate asset class worth considering.
Exactly. They frame it through that diversification mantra. Having a small, suitable allocation makes sense in a diversified portfolio, especially given the demand-supply dynamics Pomp mentioned.
It's a diversifier with significant upside potential. Fits the hurdle rate idea again.
Totally. And if you want to hear more from Ryan Dietrich, Pomp mentioned you can find him on X at Ryan Dietrich. He has a podcast, Facts versus Feelings, and the research blog at carson.com/research.
It's just incredibly insightful hearing this level of serious engagement with Bitcoin from deep within traditional finance. Shows how much things are changing.
Absolutely. Okay, let's shift gears now. Let's bring in Raoul Pal's insights from Real Vision and the Journeyman. His work often gives us that really broad, top-down macro view.
Yeah, covering the global landscape, the exponential age, crypto's future, and how tech intersects with governments and institutions.
And his whole framework is built on what he calls the everything code, developed over like 35 years in macro.
Dude, everything code. What's the core idea there?
The core idea, the single dominant factor he believes explains most asset price moves, stocks, bonds, commodities, crypto, everything is global liquidity, and the persistent long-term trend of currency debasement.
And he links this directly to debt, right?
Yeah, fundamentally. He argues the world hit peak debt, basically, in 2008 with the financial crisis. And ever since, the global economy hasn't really fixed the underlying problem.
We're just servicing the old debt.
And needing more and more new debt just to create any GDP growth at all.
He often shows that chart he considers the most important in macro.
Oh, yeah, the one correlating debt to GDP ratios with demographics. Specifically, aging populations in the West. He uses the U.S. labor force participation rate as a key indicator.
So how do those two things, debt and aging populations, interact in his view?
Well, as populations age, potential organic GDP growth slows way down. Fewer workers, lower birth rates, higher costs for pensions and healthcare.
Right, a demographic drag.
It creates less dynamic economies. And in that environment, with already high debt, you need even more debt just to service the old stuff and try to stimulate any growth. If population growth and productivity are weak, debt growth becomes the main lever.
And the consequence of all this massive persistent debt.
It forces central banks into a corner. They have to keep policies that lead to persistently low, often negative real yields.
And real yields being interest rates after inflation. So if inflation's higher than the interest rate, you're losing purchasing power.
Exactly. And when safe assets like government bonds or bank deposits give you negative real returns, it creates this powerful incentive.
Capital has to go somewhere else.
It has to. Big pools of money can't just sit there losing value. It forces capital out onto the risk curve into more speculative, higher-risk assets like stocks, real estate, crypto, things that offer the potential for higher returns. Powell calls it the only way out of the trap driven by debasement.
Yeah, to take risk to beat inflation.
Pretty much. And this debasement trend, this steady erosion of fiat currency value, he pegs it around 8% a year globally. That's the fundamental backdrop for Bitcoin's incredible performance over time.
He visualizes that with the logarithmic regression channel for Bitcoin, right?
Yeah, plotting price on a log scale shows its long-term growth trend within standard deviation bands. Bitcoin tends to follow that channel.
Though sometimes it decouples in those banana zones.
Right, during peak retail frenzy or FOMO, it can spike way above trend. But eventually, it tends to come back towards that long-term path driven by debasement and network effects.
And based on where Bitcoin is now relative to that channel, Powell's view is what?
That it's still remarkably cheap, actually, with significant upside potential remaining over the coming years within that long-term framework. He's not giving specific price targets, but just reaching the top of that channel again implies much higher levels.
Okay, let's talk the dollar, the DXY index. He calls it the largest, most important macro variable on Earth. Why?
Because something like 87% of all world trade uses the dollar. It prices most commodities, oil, gold, and it fundamentally controls global liquidity through things like the eurodollar market and international debt. The dollar's moves ripple everywhere.
And what's it been doing recently?
Well, after being kind of sideways for years, it started a big weakening trend, got extremely oversold at one point, like 3 standard deviations below trend, and has bounced a bit since.
And the historical pattern after big dollar drops is pretty bullish for risk assets, right?
Hugely bullish. He cited past 12-month gains for the NASDAQ after big dollar drops. 18%, 35%, even 61%.
And for Bitcoin, even more dramatic.
Oh, yeah. Historical instances showing 12-month gains of 119%, 175%, and one time a staggering 592% after a major dollar decline.
So why does a weaker dollar matter so much?
2 main reasons. One, it changes the denominator for global assets. If the dollar falls, assets priced in other currencies become worth more in dollar terms.
Okay, and the second?
More fundamentally, it eases global financial conditions massively. Think about all the dollar debt held by foreign countries and companies. A weaker dollar makes it cheaper for them to service or roll over that debt.
So less financial stress globally.
Exactly. Which leads to more spending outside the U.S., faster global recovery, and ultimately higher asset prices everywhere, including the U.S.
And Powell thinks the dollar's in a cycle like 2017, which was a great year for risk assets.
Yeah, potentially falling even faster this time. He sees the recent bounce as just corrective, expects new lows for the dollar in this cycle.
And this connects back to liquidity.
Directly. Global M2 money supply outside the U.S. is rising faster now than in 2017, driven significantly by the falling dollar. More global liquidity. Hugely positive for risk assets. It's basically fuel.
Okay, now moving into that exponential age theme. Powell's work, especially on the Journeyman, has really dug into the nexus of AI and crypto.
Yeah, 2 incredibly fast-moving, potentially world-changing industries, and their interaction is key.
One of the big arguments is that the currency for AI is crypto. Why? Why not just dollars?
Because AI agents, in the future Powell envisions, will be transacting with each other constantly, autonomously, at machine speed. Buying data, services, computation.
Traditional payments are too slow, too clunky.
Totally. Card swipes, bank transfers, settlement times, borders needing human approval. None of that works for high-frequency, programmatic, tiny micropayments between AIs. Only crypto, built on blockchains, can handle that natively. It's the financial plumbing for AI.
Interesting. What about data for AI training?
Blockchain is crucial there, too, for privacy-preserving data. AI needs more data, eventually private data. Public internet data will run out.
So blockchain lets individuals control their own data.
Exactly. Store your health data, browsing habits, whatever, maintain sovereignty, grant permission access for AI training, maybe even get paid for it without giving up ownership or privacy. Solves a huge bottleneck.
And it helps avoid just a few big companies controlling all the AI.
That's the decentralization argument. Blockchain helps foster decentralized AI development, ownership, access, especially with open source models like DeepSeek emerging. Avoids monopolies.
Now he's realistic about current AI tokens, though.
Oh, yeah, he says like 99.99999% are useless or scams right now. But the goal, the future, is real AI agents with real utility, powered by functional tokens for payments, access, governance within these AI ecosystems.
And the big picture is AI agents trading with each other, driving commerce.
A heavily automated future where AI to AI commerce is a huge part of the economy, potentially shifting the engine from humans to AIs. Crypto is the essential infrastructure for that.
So AI plus robots plus blockchain equals a totally new productivity equation.
Potentially. Maybe the world with less traditional human work needed because AI and robots handle it, paid for via crypto. It's a profound shift.
Which brings us to global adoption in governments, something Powell explored with CZ, the former Binance CEO, on the Journeyman.
Yeah, that was a fascinating chat, getting CZ's perspective from talking directly to world leaders.
What's CZ focused on now?
He's talking to leaders in about a dozen countries, advising them on crypto and blockchain adoption strategies.
And he's seeing a change in attitude.
A big shift, he called it, just in the last 6 months. A real acceleration. He specifically mentioned the new U.S. administration being, in his view, extremely pro-crypto behind the scenes, and noted Elon Musk's interest in using blockchain for government efficiency.
Beyond just finance, what are governments exploring?
Lots of stuff. He used UAE Dubai as examples, exploring blockchain for decentralized IDs, which need crypto wallets.
For interacting with government services.
Right. Things like land titles on the blockchain, bank accounts, e-visas, border crossings, even education diplomas. CZ sees blockchain expanding into multiple dimensions of government.
Still challenges, though, right? Regulations.
Definitely. Many regulators want everything: local custody, order books, teams. CZ argues that's often not the best or safest way.
And the U.S. government.
They hold a lot of seized Bitcoin and seem to have stopped selling it. CZ sees the current admin stance on holding it as business savvy.
And this forces other countries' hands.
CZ thinks so. With big players like the U.S. and early movers like Bhutan holding, other countries feel compelled to start accumulating too. Waiting just makes it more expensive if demand keeps rising.
What advice does he give them on setting up reserves?
How to do it securely. Recommends professional custody with multi-sig initially for smaller amounts. For larger strategic reserves, eventually move to self-custody once they build internal expertise.
Multi-sig meaning multiple keys needed to approve transactions.
Exactly. Much more secure.
What about Europe in all this?
Strikingly, he said they're nowhere in these national adoption talks, called it unbelievable, except maybe Montenegro, which is apparently quite pro-crypto.
It's ironic, isn't it? European regulators sometimes block average people from crypto wealth generation.
While other nations are strategically stacking it at the state level. Yeah, definite irony there.
What's CZ's take on the current market cycle?
Well, he's famously always bullish, even in crypto winters. Acknowledges timing is super hard, focus on the long view.
What's driving this cycle, in his view?
The ETFs. Primarily the U.S. bought Bitcoin ETFs bringing in massive institutional money. That's the biggest driver right now.
And what about other cryptos, like ETH?
They haven't seen that direct ETF flow yet, obviously, but he thinks capital tends to disperse from Bitcoin over time as investors get comfortable and explore.
Bitcoin's the gateway drug, basically.
Kind of, yeah. It's usually the first crypto people touch, but once they're in, they explore others.
So, overall cycle view? Still early.
Very early, he thinks. Handful of countries starting reserves, ETFs only months old, everything's just beginning.
What's his advice for new people coming into crypto?
Key things. No magic bullet, no secret formula, stick with fundamentals.
Don't chase hype.
Definitely not. No FOMO from tweets.
Yeah.
Look at projects, play with the product, understand it, believe in it.
And research is key.
Absolutely. Don't follow blindly. Do your own research DYOR. Invest in just a few, maybe 3 to 5 tokens you understand deeply. If you don't get it, don't invest. Simple.
And for builders.
Similar focus. Fundamentals, product market fit. Build prototypes, test, pivot if needed, scale if it works. Success isn't just fundraising, it's users and value years from now.
So his summary is...
Hold on. Be patient. Don't mess it up with emotional trades. Build something important with a mission and use AI.
Good advice. And hey, speaking of updates, you can drop a follow on Twitter for more updates from us, too.
No segue. Okay, finally, let's put a spotlight on some extra insights from Mark Meldrum's recent Q&A. He hit on AI, macro, and the crucial need for financial literacy and critical thinking now.
Right. Someone asked him about AI replacing psychologists or psychiatrists. What was his take?
He acknowledged AI therapist agents exist, sees potential for them handling common everyday problems cheaply and accessibly, if they can truly absorb the needed knowledge and techniques effectively. The quality and depth are the big ifs.
He also talked about AI as a deflationary force.
Yeah, a potentially powerful one. Increased productivity, reduced costs for companies adopting AI that pushes prices down.
But what about companies that don't adopt AI?
They might face relative inflation compared to adopters, sure, but his overall view is that widespread tech integration trends towards deflation over time.
Which contrasts with Jamie Dimon's view, right? Dimon sees big inflationary forces like deficits, rearming, green spending.
Exactly. Meldrum countered that. He pointed to history, Japan, 2010, 2020, parts of U.S. history showing massive money printing and deficits without runaway inflation.
So what caused the recent inflation spike, in his view?
Supply constraints, mainly. Pandemic, geopolitical stuff, not just demand or printing alone. And higher interest rates hit demand but don't fix supply issues. So technology remains a primary deflationary force.
How did he explain the stock market rally then, if not just inflation?
Deficits driving aggregate demand. His take was almost cynical. Market cheers the spending, thinking, yay, deficits, deficits, and deficits, who the hell cares, we get paid first. Demand injection.
What about the bond market's worry about debt? Is it a crisis?
He acknowledges it's unsustainable long term. We're barreling towards a debt crisis eventually. But it's not a crisis yet
Why not?
because investors are still willing to lend the government money. He cited high bid-to-cover ratios at Treasury auctions, strong demand for bonds, keeps borrowing costs manageable for now, crisis averted for now.
Okay. What about specialized AI models for finance versus the big general ones like Gemini or Claude?
Meldrum's skeptical about the need for separate finance LLMs long term. He thinks the big models are already so capable with finance tasks.
That they'll just absorb that functionality.
Yeah, basically eat and gobble up or subdivide internally to cover finance. Doesn't see standalone finance LLMs surviving against the giants.
What about AI and jobs? Mass layoffs coming.
His nuanced take is the first big hit will be a lack of entry-level positions. AI does junior tasks, so less need to hire there.
Which could, weirdly, make it easier for the Fed to cut rates.
Potentially, yeah. Because it's a form of demand destruction in the labor market without mass layoffs, initially anyway.
Did he think AI replaces search engines?
He argued AI is search, just better, contextual search. Cited Manus AI searching websites. Said human browser searches might be down, but overall search activity via AI tools is likely up.
And open source AI is competitive.
Yeah, mentioned models from China, Manus AI. They're catching up fast. Big deal for the landscape.
This all leads back to financial professionals and really everyone needing AI literacy, right? But more importantly, critical thinking.
Absolutely. His key point, AI won't replace good analysts, but it will replace the bad ones.
Why the distinction?
Because AI does the heavy lifting but produces standard results. If everyone uses the same AI on the same data, everybody gets the same thing. Your edge disappears if you just repeat the AI.
So the value is in.
Critical thinking and reasoning. Questioning the AI, synthesizing info in new ways, applying judgment, understanding context to AI misses. That's the human advantage.
He used Bloom's taxonomy.
Yeah, the hierarchy of learning. Humans need to climb past basic knowledge and application to analysis and evaluation. Higher order skills LLMs struggle with. That's where good analysts live.
So finance exams like CFA need to change.
He argues they must integrate AI literacy, push analysis and evaluation skills much earlier, even level 1. The future needs experts who leverage AI with critical thinking, not people replaced by it.
He had that car test drive analogy too.
Right. Evaluate the experience and output, the drive, not the engine mechanics. Same with AI. Evaluate its output and learn prompting. Don't obsess over the model's guts.
And AI just aggregates human knowledge. It's not truly intelligent itself.
That was his point. It's embodied intelligence, an amazing emulator, but lacks genuine consciousness or reasoning like humans have.
Okay, shifting to market indicators and investment advice. Lots of conflicting data now.
Yeah, so much uncertainty, he said, about the current cycle phase.
So for long-term investors,
His advice is consistent. Don't worry about timing the cycle. Just buy the market regularly. Ignore short-term downturns. Governments tend to bail out crises anyway, and buying lower helps long-term.
any other quick points from him?
Japan's debt is concerning, but not a crisis yet. Fed focuses on its mandate, inflation employment, not controlling long rates directly. Higher long rates actually make Fed more likely to cut short rates because they tighten credit already.
Interesting.
Yeah. Also mention M2 GDP correlation, uncertainty around rate cuts, Google winning AI, maybe on reach, not just tech, importance of domain knowledge over chasing trends, and considering political figures as volatility factors.
Wow. Okay. We have covered a ton of ground in this deep dive, pulled from some really sharp sources across macro, markets, crypto, AI.
It's a lot to process. We've seen how fast tech, AI, blockchain is evolving and really hitting global finance, government strategy, even personal data and work.
Heard compelling arguments about long-term trends like debasement pushing capital to assets like Bitcoin, seen surprising historical data on stocks.
And wrestled with those conflicting views on where markets or the economy go next.
And crucially, how all this is changing what skills are needed. Moving beyond just processing data to needing that higher level critical thinking, analysis, evaluation, leveraging AI, not competing with it head on.
Right. Which leads us to that final kind of provocative thought for you, the listener, to consider.
Okay, what is it?
In a world where AI might become the currency for other AIs, where governments are seriously looking at Bitcoin reserves and using blockchain for services, and where the very skills needed to understand and succeed in markets are shifting because of tech and macro changes, how does your personal framework need to adapt?
Your framework for understanding the world, for making decisions.
Exactly. Is your current approach keeping pace with this acceleration? Or is the market, like Ryan Dietrich said, acting as the referee? Maybe telling you it's time to reconsider some core assumptions about how you filter information and decide what to do.
Definitely something significant to think about as all these trends keep playing out.
Markets move fast. Pinpoint your next profit window and seize the moment.